Cost segregation allows a real estate investor to more rapidly depreciate certain components of the building, of the acquisition or new construction of a building. The cost segregation study will separate out components of that building that have a shorter class life for depreciation.
Welcome to our commercial real estate series, Behind the Building, giving the audience a behind-the-scenes look at different aspects of commercial real estate, featuring industry professionals and leaders who we work with every day to make it all happen. With me today is Kevin Giles, co-owner of Giles Flythe Engineering, a firm that works with commercial and residential property owners in problem solving, repair maintenance planning, pre-purchase due diligence, and cost estimating. Welcome, Kevin.
Awesome. Happy to be here, Emily. Appreciate the invitation.
So Kevin and I were talking at one of the last CCIM meetings, and he made me aware of the cost segregation services, not just that they do them, but that the newer legislation that was just enacted, it's created conditions to save property owners really big dollars. And so I wanted to bring that to this episode today, because I thought it was super interesting and could help our investors, buyers, and clients do so much better with their investments. So first, Kevin, tell us about what cost segregation is. How does it work?
Sure. Yeah, thanks, Emily. Cost segregation allows a real estate investor to more rapidly depreciate certain components of the building, of the acquisition or new construction of a building. Basically, the standard straight line depreciation method for commercial real estate is 39 years. So you take the value of the building, not the land. We can't depreciate land, but the value of the building that you have acquired, and you divide that by 39, and that becomes your annual depreciation expense. A cost segregation study will separate out components of that building that have a shorter class life for depreciation. So for example, carpet has a 5-year class life for depreciation according to IRS standards. So that component, the value of that carpet, would be separated out to a shorter class life. So basically, a cost segregation study would allow an investor to more rapidly depreciate components of the building, thereby reducing their tax burden in the near term. Ultimately, it's more of a time value of money calculation. It's more of give me the money now as opposed to later, because eventually, as you're depreciating, you're reducing your basis. At some point when you sell, your gain is going to be on your basis. So it is more of a time value of money kind of calculation than a just pure, here's some tax credit. It is more rapidly depreciating components of that building.
So then in 2024, here comes the one big beautiful bill. And instead of that depreciation phasing down, it was then reset to 100% bonus depreciation. So explain how that concept then impacted, and what would that mean to an investor or buyer who has been sitting on the sidelines and they didn't realize this was available to them. And, if they were contemplating purchasing a $5 million building, how does that impact what they're doing, especially in the first year?
Yes. So the one big beautiful bill made permanent, as permanent gets within Congress, made permanent the 100% bonus depreciation provision. So basically, any components of a building that are assigned a class life of less than 20 years. So basically, all of the site improvements, so your asphalt paving, the concrete flat work, all of the interior improvements that are class life of 5 years, your carpet, a lot of the electrical systems, a whole bunch of different components. The value of all of those components that are separated out as part of a cost segregation study basically qualify for 100% bonus depreciation in the very first year. Prior to 2025, the One Big Beautiful Bill Act, prior to that, the bonus depreciation had stepped down to, I believe, 40% for 2025. Now it has been re-upped to 100%. So 100% of those components, those shorter class life components, qualify for 100% bonus depreciation in the first year. In practicality, what that means, we generally see somewhere around 15 to 30% of the acquisition cost being able to carve out into the shorter class life components. So if you buy a building for $10 million, somewhere around 2 million to 3 million of that potentially 1.5 to 3 million of that would basically result in first year bonus depreciation. So you would take a depreciation expense in the very first year of somewhere in that 1.5 to $3 million of that $10 million acquisition. Yeah, so it can be a big windfall for you now have a major depreciation expense to offset any income on that property in that very first year.
Yeah, yeah. And you said it before, but I think it's worth restating that this depreciation recapture, it would still exist on the sale of the
Hmm?
property. So it's not a permanent elimination of that tax. It's more of a tax
Yes.
deferral strategy, and
Yes.
it dramatically improves that first year cash on cash return so that significantly enables landlords to do a little bit more, maybe in the way of tenant improvement, abated rent, and things like that to really get that first year kicked off well.
Yeah, yeah. A couple things to consider on the cost segregation study, and you're exactly right, Emily. It is reducing your basis in that property. Any depreciation that you take is going to reduce your basis in that property. When you sell the building eventually, your taxable gain is going to be on the difference between the sales price and whatever that basis is. And so as you depreciate a building, you are reducing that basis, so the gain will become larger. So there are some recapture considerations. Basically, our general rule of thumb is you need to be planning to own the building at least 4 or 5 years, if not longer, to really take the value of that time value of money. Getting all that money now, what are you able to do with that money today that's really going to maximize that return over those years? If you're planning to buy the building, only own it for 2 or 3 years, it's probably not worth it to go through the cost segregation exercise. It might be something that you can run some numbers and check with your CPA as well, and we could help with that as well. So yeah, number one, it is a time value of money problem, right? That is where the savings is you're getting the money now. Number two, if you are taking this $2 million depreciation expense in the very first year, you're most likely not going to have $2 million worth of income coming off of that property that can directly offset it. If you are not a quote real estate professional according to IRS standards, you cannot use that loss on that property against active income. So if you are an owner, operator, owner, you own a business and you've acquired this building and you are not a quote real estate professional, you might not be able to use all of that depreciation loss in that first year. Something to consider, something to talk with your CPA about regarding if you qualify as a real estate professional. Now, if you do qualify as a real estate professional, you can use that full 1.5, $2 million of depreciation expense against other income, not just that property, but against any other income that you have. So a huge benefit for real estate investors that are considered real estate professionals by IRS standards.
Certainly, so many nuances that it's so important to have you on speed dial to be able
Sure.
to advise when it's appropriate to use a cost seg study or not. What does that mean? What are their goals alongside their CPA, of course. But yeah, just going through the cost segregation study, a lot of people think it is just math and Excel spreadsheets that CPAs work on. So why is it critical to have a firm like Giles Flythe work on the study and help alongside your actual engineers
Sure.
instead of it just being with a CPA?
Sure. And it's kind of a blend of engineering and accounting. So we need to know a lot about tax code, a lot about tax court cases, which items qualify for 5 year class lives as opposed to 15 year, as opposed to 39 years. So we need to know some of that information. But the bigger part of it is in cost estimating. We need to know how much does it cost to install drywall? How much does it cost to install carpeting? How much does it cost to install a stormwater pond? What is the cost to install asphalt paving? So a big part of it is the estimating of those construction costs, that replacement cost for those components. Specifically regarding who should be doing a cost segregation study, the IRS publishes what's called the Audit Technique Guide for Cost Segregation Studies. It's basically meant as a guide for IRS agents to teach them how to audit cost segregation studies. It is a published document. I will certainly send that over to be included in the show notes, a link to that. It's a long document, but within that, the IRS is providing guidance to their IRS agents of how to audit a cost segregation study. Within that framework, within that big document, they list out principal elements of a quality cost segregation study. So how to know if this is a quality cost segregation study. And within that document, I will read specifically that a quality cost segregation study is prepared by an individual with expertise and experience. In general, a study by a construction engineer is more reliable than one conducted by someone with no engineering or construction background. So even in the IRS's guidance on who should be performing a cost segregation study, they're citing that need for the ability to accurately estimate cost and specifically recommending a construction engineer to be doing that cost segregation study. I will say we do work directly with the CPAs though. So if you have a CPA, your CPA, that is a relationship that we are going to work directly with. We are basically doing the cost estimating and assigning class lives part of it. They are implementing that into an asset register into your actual tax return. So it is kind of a blend there. We certainly recommend both be involved in your tax return with the cost segregation study, both a CPA and a engineer.
Yeah, and with the 100% depreciation being so aggressive and dramatically affecting a taxpayer's bottom line, it seems like that IRS scrutiny would be higher. So, to the point of your engineer-based report would seem to protect if the IRS came
Yes.
knocking.
Yep. I mean, our goal with our cost segregation studies is to provide, I'm not going to say audit proof, but we are well documenting all of the decisions of class lives. We are well documenting how we derived our cost estimating, how we derived the cost of all the different components, basically modeling it after that 300 and something page audit technique guide where we want to make sure we're checking all the boxes. We're doing everything that the IRS is advised should be done so that in the event of an audit, that it will come back clean, that there will be as little amount of friction as possible. Typically within our industry, most of your engineering firms or engineering groups that are providing cost segregation studies, they will offer to, within their scope at no additional expense, offer to provide some assistance in the event that there is an audit. So if our client does get audited, we are available at no additional expense to provide some guidance and consultation through that audit process, to answer questions from an IRS agent, to respond to the review or inquisitions through that process as well. So we definitely want to be fully supporting of those audits. And it is interesting. It does kind of feel like it might set off some red flags, but at the same time, in the current administration, the number of IRS agents and the budget for the IRS, I think, is being scaled back. So we are not seeing that significant of a volume of audits specifically related to cost segregation studies.
I imagine it's a little early too, because
Yes.
not everyone knows about this, and so they're just kind of catching on at this point.
Mhm. Yeah.
Um, well, let's talk about industrial assets. As I was doing my homework, it sounds like the new bill created significant incentives for industrial assets when used in qualified production. Tell us about that qualified production and
Yeah.
how it works for sounds like an owner user would be the one who could benefit from this.
Certainly. So yes, the new bill, the One Big Beautiful Bill Act from last year, from 2000, summer of 2025, it introduced what is called qualified production property. And it allows 100% bonus depreciation on any qualified production property with several caveats. Probably the biggest one being the taxpayer has to be participating in the production activity. And they're defining production activity is basically making an improvement to a component. It is not merely storing, it is not merely a warehouse. You actually have to be doing something to that widget to improve that widget, to do something to add value to it, and then ship it out. So it is you bringing in a raw material. It could be food processing. It could be traditional manufacturing. It could be any number of things, but you have to be doing something, some sort of production activity on that component before shipping it out. So that is what would define as a qualified production activity. So then any building or infrastructure that is constructed or upfit to support that actual production activity would qualify for the 100% bonus depreciation. However, another caveat, it has to be done by the taxpayer. The taxpayer has to be the one that is actually doing the production activity. Mm-hmm. So if you buy a building or construct a building with kind of a build to suit agreement for some sort of widget manufacturer, and that widget manufacturer is going to lease the building from you, you as the owner of the building are not performing that production activity. So you as the owner of the building would not be able to use to take that bonus depreciation on qualified production property. However, if it's the more traditional, maybe a smaller manufacturer where we are producing widgets and we have a separate LLC with roughly the same ownership group that is going to own the building and is paying for the construction cost of the building. In those cases, you can likely use the qualified production property. But if you're solely a standalone investor that doesn't have any ties or any relationship to the actual production property, you would not qualify for that. Third caveat on this, it appears to be, and the IRS just sent out a new update to this, to where they provided some qualifications to this, and I was on a conference call, tech call regarding this. It seems that it is only going to apply for new construction or upfit. If you just merely acquire an existing facility, it is not going to qualify. There's some rules in there regarding that property cannot have been used by any taxpayer for any other production activities in the past 5 or 6 years or something like that. So it seems to be guided. I think the goal of this was to encourage construction projects around building manufacturing facilities or upfitting existing buildings to make them into manufacturing facilities. I think that's the overall goal of the legislation, is to encourage that activity. So merely an acquisition of an existing manufacturing facility would not likely qualify, and you have to be involved in that activity as well. It gets very complicated pretty quickly.
Mm-hmm. So some of the nearshoring that the administration is really promoting, mm-hmm. I imagine that is who that's targeting.
Yes, directly tied to that activity. Mm-hmm. Yes.
Yeah. One area that we met, Giles Flythe, you all had done a property condition assessment, mm-hmm. PCA for short, mm-hmm. For a building I had for sale. And it's basically an inspection of the entire property, points out deficiencies and suggested remedies. It's a whole lot of pages. You put a lot of work into it. And it tells, the buyer or investor all that there is to know generally about that property. And so tell me how it works in tandem when you do a cost segregation study. How does that benefit the owner or buyer?
Yep, that's a great question. So yes, we do property condition assessments, that due diligence exercise. You're in contract to buy a building. We're going to go do an inspection of everything within that property and tell you what's wrong with it. That is a standalone due diligence property condition assessment report. After you've acquired it, if you elect to do a cost segregation study, we can offer a good bit of cost savings to kind of pair those projects up. Our engineers have already been inside the building. We've already documented all the HVAC, the electrical, all the different components within that building. We're not going to have to do a secondary follow-up inspection. Our second inspection for a cost segregation study after the closing would be much smaller. It would be much shorter time window. We wouldn't have to be on site nearly as long as if we were just doing a standalone cost segregation study. So ultimately, yeah, there's going to be some savings with their pairing up those projects together. That's why we would typically offer that as an option within a proposal on the front end. If you know you're going to do a cost segregation study on it, we can offer some savings because we're already collecting all this data once through the property condition assessment. We don't have to collect it all again as part of a cost segregation study.
Yeah. So let's stay on the topic of the purchase agreement. You're in the middle of the inspection or examination period, and you, through the PCA process, you find that there's a major deferred maintenance issue, like a $700,000 roof that should be replaced. How do you help that buyer or investor weigh the cost of the repair against the tax benefit of that immediate 100% write off for the new roof?
Sure. So as part of our process with the cost segregation study on the front end, before you've even done the cost segregation study, we can provide what's called an estimated benefit analysis. So we would take a look at the details of your property, if it's an industrial building or a hotel or an office building or shopping center, and we would compare that to our volume of previous experience and be able to give you a pretty close kind of estimate of what will the results of this cost segregation study actually be. So you can kind of model out what that cash flow improvement would be in the very first year, how much of it would qualify for bonus depreciation. We usually give a range somewhere between 8 and 15% of it may qualify for 5-year property. Another 10 to 20% of it may qualify as 15-year property. But we'll kind of do the math on the front end to give you a range of this is what you can expect as a benefit from this cost segregation study. That would help the investor be able to plan for those expenses, be able to see, all right, what is that pro forma? What is that cash flow really going to look like in the first year, first 2 years, first 5 years of owning this property? Yeah, it can help them negotiate with that knowledge so they know more sharply exactly what that cash flow is going to look like in those first couple of years. Could certainly help them negotiate as part of that process.
Yeah. So as we round out this interview, let's switch up to land a little bit.
Mhm.
We so oftentimes focus on the building in our real estate dealings, but the one big beautiful bill, it does give a huge win for 15-year land improvements, from what I understand. So, what are some of those often overlooked outdoor assets that you're able to segregate in order to trigger the 100% write off?
Yes, that's a great question. The land improvements part of it is a big benefit of cost segregation studies. Basically, the value, the replacement cost, the full replacement cost of any asphalt paving, of any concrete flat work, of all the retaining walls, of all the street lights, of any monument signage. One of the big ones that gets overlooked a lot is the stormwater pond infrastructure. So if that property has a stormwater pond on it, the full replacement cost for constructing that stormwater pond, including the underground, often reinforced concrete pipe, stormwater infrastructure, all of those components, all of the value of those components are able to be segregated out into a 15-year class life. And since that's less than 20 years, as we talked about previously, all of that would qualify for 100% bonus depreciation in the very first year. I think the stormwater pond infrastructure is probably the one that's often overlooked in terms of a value to this, as how that would be the value of those being carved out into 15-year property. Asphalt paving is very visible, pretty straightforward. Oftentimes the stormwater pond's kind of at the very low end of the property, maybe tucked off into the woods a little bit. Nobody even really notices that it's there. That can be a big benefit from a cost segregation standpoint. Now, it works best. Shopping centers are wonderful for this because they have really big parking lots. They almost always have at least one stormwater pond, if not multiple. They got big entrance monument type signage. They have a whole lot of concrete sidewalks, flat work, concrete curbing, all of that stuff. Those work very well for the land improvement part of the cost segregation study. On the opposite end of that, an industrial building with a really rough gravel parking lot and maybe just a fence, that's not going to do as well. There's not going to be as much value there to carve out in terms of a 15-year shorter life property. So yeah, if you acquiring something with a big parking lot, stormwater ponds, and that type of stuff, that's going to be very beneficial from a cost seg study perspective. There's a lot of value that will be carved out into those components.
Yeah, that's really good information. And the buyer retention ponds can be so expensive
Yes.
to install, and especially with our stormwater regulations
Mhm.
that could be different through the different municipalities.
Mhm.
So that'd be a great benefit for sure. Well, I
Yes.
think, Kevin, that concludes our interview today. I think that's all the cost segregation information that I could
Yes.
take in. I mean, it's such a big topic and so nuanced, and it's just been a wealth of information. So I really
Yeah.
appreciate you being on this Behind the Building series, and
Awesome.
we'll have you on again to talk about some of the other
Sure.
services that Giles Flythe does perform that are so
Mhm.
important to the upkeep, the planning, the return on investment that you need to be informed of whenever you own property. So,
Awesome. We
yeah.
appreciate the opportunity, Emilee. It was great chatting with you. And yeah, hopefully we provided a little bit of information on the cost segregation study industry and how this can be a benefit.
Mhm. So I encourage all the viewers to reach out to me as I want to be your resource for all things commercial real estate. I can help connect you with Kevin from Giles Flythe Engineering, especially if you have any questions about their services that are critical for maximizing the value, function, and return on your property. Thank you for joining us, and be sure to keep an eye out for future Behind the Buildings interviews with other industry professionals just like Kevin.